10 days ago, a company sold itself to the public for more money than any company in history. The headline said the same thing, over and over. This is the most cash-rich business on earth. $100 billion in the bank, more than Microsoft. And then, 10 days later, that same company did something strange. It went out and borrowed $20 billion more. The stock fell 16% in a single day. But is that actually true, that a company drowning in cash needs to borrow? I'm Aurie Caelum. I dig into the facts about money that most people walk straight past. Today we follow one number that doesn't make sense, and we don't stop until it does. 3 things today. 1. Why a company with $100 billion borrows anyway. 2. Why the people lending it money lined up while the people owning its shares ran for the exits. 3. What this single deal tells us about the entire money machine being built around artificial intelligence. Stay with me to the end. This changes how you see it. Before we start, let's be clear about what this company actually is, because the cash number hides a second story underneath it. The company is SpaceX. You know it for rockets. But over the past year, it became 3 businesses wearing one coat. Rockets, which launch things. Starlink, the satellite internet service that actually earns the money. And an artificial intelligence arm folded in earlier this year that burns money at a frightening rate. Here's the simplest way to picture it. Think of the company as one body. Starlink is the heart. It pumps the cash that keeps everything alive. The rockets are the legs. They carry the whole thing forward, launch after launch. And the AI arm is a brand new, very hungry brain that was grafted on this year. That brain is the key to everything that follows, because a brain that powerful doesn't run on willpower. It runs on electricity, on buildings full of computer chips, on rivers of money, and right now, it gives almost nothing back. So here's what actually matters. The $100 billion cash pile is real. The company told bond investors it held roughly $100.8 billion on June 19th. But that number arrived only 10 days earlier from the public offering itself. It's not profit the business saved up. It's the money strangers just handed over. And underneath that shiny pile sits a debt most people never saw. Back in February, the company swallowed its sister AI startup. To pay for it, it took a temporary loan, a bridge loan, of $20 billion. That single loan makes up the bulk of its long-term debt, around $29 billion in total. Think of it like this. You've maybe bought a house with a short-term loan, planning to swap it for a proper mortgage later. The short-term loan buys you time, but it comes due on a hard date. Miss that date, and the whole arrangement falls apart. A bridge loan is exactly that. A plank you must replace before it rots. That's exactly what's happening here. The bridge loan comes due in September 2027, and here is the part the cash pile cannot change. That deadline is not flexible. It doesn't matter where the stock trades or how much cash sits in the bank. The loan must be replaced with permanent debt, one way or another, before it matures. So now the strange headline starts to make sense. The company didn't borrow $20 billion because it ran out of money. It borrowed because a clock was already ticking on an older debt and waiting was never an option. But that's not the end of it, because the reason it could borrow so cheaply is a story in itself. And it's the second thing I promised you. A week before the bond sale, 3 referees of the financial world gave their verdict. Moody's, Fitch, and S&P, the 3 big credit rating agencies. Each one stamped the company investment grade. In plain terms, safe enough that even cautious lenders are allowed to lend. Why does that stamp matter so much? Because it opens a vault of money that junk-rated companies can't reach. Pension funds and insurance companies, the most careful money in the world, are only allowed to buy investment-grade debt. The stamp doesn't just lower the interest rate, it widens the crowd of people permitted to lend, and lend they did. The company planned to raise $20 billion. Demand was so heavy that orders reached nearly $90 billion. So the bankers raised the size of the deal to $25 billion. The lenders weren't running away. They were fighting to get in. Now you might be thinking, if lenders were that eager, why did the stock crash on the very same news? Hold that question. It's the heart of the whole episode, and the answer reveals something most people get backwards about how markets work. Here's where most people get confused. They assume the lenders and the owners want the same thing. They don't. A lender, a bondholder, wants only one outcome: to be paid back on time. They don't need the company to soar. They just need it to survive until the debt is repaid. An owner, a shareholder, wants something completely different. They need the company to grow, to win, to turn today's losses into tomorrow's profits. And when those same rating agencies opened their files, they showed the lenders comfort and the owners a warning. The very same document. Two opposite reactions. What was in that warning? S&P projected the company would burn cash, spend more than it earns, every year through 2029. Moody's flagged how much power sits with a single individual at the top. Both pointed at the same hungry brain we drew earlier, the AI arm, with its enormous appetite and its uncertain payoff. Think of it like this. Imagine a restaurant that's wildly popular but loses money on every plate, promising to make it up on volume someday. A landlord lending against the building feels safe. The property holds its value, but a partner who owns a share of the profits? They lie awake because the profits are still a promise. That's exactly the split here. The bond crowd saw a fortress wall, Starlink's steady cash, and a dominant launch business. The stock crowd saw the warning label and a mountain of spending still ahead. Same company, same week, opposite verdicts. And then a second weight landed on the stock at the worst possible moment. Just days before, for the very first time, traders were allowed to bet against it through options that let people profit if shares fall. Before that, betting against the company was nearly impossible. The door to pessimism had simply not existed yet. So the bond news didn't fall on calm water. It landed exactly as the tools to bet against the stock arrived, and as everyone remembered, a flood of insider shares would soon be free to sell. 3 pressures, 1 moment. The drop wasn't a single blow. It was a pile-up. Now, blind optimism is dangerous. Let's check the other side, honestly. This is analysis, not investment advice, because there's a version of this story where the borrowing is not a warning at all, but a smart, ordinary move. Here's the genuinely clever part. That original bridge loan replaced even older, costlier debt that once charged interest as high as 12.5%. The bridge cut the effective rate to around 4.5%. Refinancing again into long-term bonds locks in cheap money for decades. By the rules of corporate finance, this is textbook housekeeping, not panic. And the cash pile, while raised rather than earned, is still real runway. It buys years to build the next rocket, expand the satellite network, and feed the AI arm. Long enough, perhaps, for the promise to become profit. The bull case isn't foolish. It just requires patience the stock market rarely has. This is how the big money, the smart money, actually reads it. They separate the two questions the crowd keeps merging. Question 1, can this company pay its debts? On that, the careful money said yes and bought the bonds. Question 2, is the stock worth its price? On that, the same careful money stayed cautious. That's the lesson hiding inside the headline. Lending to a company and owning a company are not the same bet. One asks, will it survive? The other asks, will it win? A business can be a safe loan and a risky share at the very same time. This one, right now, is exactly that. 3 checkpoints to watch. just three. First, the bridge loan. Watch whether it gets fully repaid and retired cleanly ahead of that 2027 deadline. A clean refinancing turns the scariest number on the page into a closed chapter. Second, the AI arms appetite. Watch whether its spending starts producing real revenue, actual customers paying real money rather than just bigger bills. The compute deals already signed with other technology firms are the first thread to pull. Third, the supply of shares. Watch the calendar for when insiders are first allowed to sell. When a large new wave of shares can suddenly hit the market, price often feels the weight, regardless of how good or bad the business is that week. But don't get carried away. Let's be objective about the risks. Watching is not the same as betting, and every checkpoint above can break the wrong way. Risk 1. The deadline itself. If lending conditions sour before 2027, if interest rates climb or lenders lose their nerve, replacing that bridge loan gets harder and dearer. The investment grade stamp helps, but it is not a guarantee that the door stays open. Risk 2. The cash burn. A forecast of spending more than you earn every year through 2029 is a long time to ask investors to hold their breath. If the AI payoff arrives late or smaller than hoped, the patience runs out before the profit arrives. Risk 3. Concentration. So much rests on one person's decisions and one division's success. When a single brain steers the whole body, the body moves fast, but it can also walk straight off a cliff with no one able to grab the wheel. Let me bring it together. A company raised a record sum, then borrowed more, not from weakness, but because an old clock was ticking. The careful money lent eagerly because survival looked secure. The owners flinched because winning still looks uncertain, and the timing of it all turned an ordinary refinancing into a 16% fall. But step back, there's a bigger picture worth seeing here. This single deal is one brick in something enormous. Across the industry this year, companies building artificial intelligence systems have borrowed at a near record pace, well over $100 billion in new debt, far ahead of last year's total. That is the quiet story behind the loud headline. The machine being built around artificial intelligence is not just powered by chips and electricity. It is increasingly powered by borrowed money, debt that assumes the profits will arrive on schedule. This one company is simply the clearest window into that bet. Don't overcomplicate it. Hold one realistic picture in your head. A company can be a safe place to lend and a risky place to own at the exact same time. And the gap between those two truths is where the whole drama lives. If you remember one thing today, make it this. When you see a number that doesn't make sense, a rich company borrowing, a stock falling on good news, don't look away. Look for the second story underneath. It's almost always there, and it's almost always the part that matters. That's the case, laid out as honestly as I can. The borrowing made sense. The fear made sense. Both were true at once. The rest is for time, and the 3 checkpoints to settle. If this made something click, a like genuinely helps. It's how more people find these. What are you watching right now in the markets? Tell me below. I read them. I'm Aurie Caelum. Mind the second story.